Welcome to House Lux Estate, your go-to channel for financial wisdom and insights. We are here to guide you through the world of finance, providing you with the knowledge to navigate the often turbulent waters of economic uncertainty. Today, we're tackling an important topic that's been on the minds of many: how to protect your savings in the event of a bank failure. Now, you might be thinking, bank failure? That's not going to happen, right? Well, the truth is, while it's not a common occurrence, it's not unheard of either. And when it does happen, it can have serious implications for your hard-earned savings. That's why we believe it's essential for everyone to understand how to safeguard their savings against such an event. We're going to walk you through the steps you can take to protect your financial future, offering practical tips and strategies that you can implement right away. So buckle up and stay with us as we delve into this crucial topic. Firstly, it's important to understand what a bank failure is. A bank failure happens when a bank is unable to meet its obligations to its depositors or creditors because it has become insolvent or too illiquid to meet its liabilities. In simple terms, it's when a bank runs out of money. Now, this might sound terrifying, but it's essential to remember that bank failures are relatively rare occurrences. So why do banks fail? There are several reasons. Sometimes it's due to poor management and bad decision-making. For instance, a bank might have made too many risky investments or loans that borrowers can't pay back. Other times, economic conditions can lead to bank failures. In a recession, for example, many people might lose their jobs and be unable to repay their loans, causing banks to lose money. Additionally, banks can fail due to a loss of confidence. If people believe a bank is in trouble, they may rush to withdraw their money, a phenomenon known as a bank run. If a bank run occurs, it can exacerbate a bank's financial difficulties and lead to its failure. Now, you might be asking, what happens to my money if my bank fails? When a bank fails, it's usually taken over by a government agency called the Federal Deposit Insurance Corporation, or FDIC. The FDIC's job is to protect depositors by insuring their money up to a certain limit. This means that even if your bank fails, you won't lose all your money. However, there may be a period of uncertainty and inconvenience as the FDIC works to sort things out. But here's the catch. The FDIC insurance only covers up to a certain amount. So if you have more than that amount in your bank, the excess might be at risk. Now that we understand what a bank failure is, let's move on to how we can protect our savings. One of the key steps in protecting your savings is diversification. When it comes to safeguarding your wealth, diversification is your best friend. It's like the old saying, don't put all your eggs in one basket. The same principle applies to your savings. Let's break this down a bit. Diversification is essentially about spreading your savings across different types of investments or financial institutions. The goal? To reduce risk. If one investment or bank takes a hit, not all of your savings will be affected. Imagine you're a tightrope walker. Would you rather walk across a single tightrope or across several ropes tied together? The answer is clear, isn't it? The multiple ropes represent diversification. They provide a stronger, more balanced support system. Now, how can we diversify our savings? There are multiple ways to do this. One approach is to distribute your savings across different types of financial instruments. This could include savings accounts, bonds, stocks, mutual funds, and more. Each of these has its own risk and reward profile, so they can balance each other out. Another way to diversify is to spread your savings across multiple banks. This way, even if one bank faces difficulties, your savings in other banks remain secure. It's all about not tying your fortune to the fate of a single institution. Remember, diversification isn't a one-time action. It's a strategy that requires regular review and adjustment. As economic conditions change, so too should your diversification strategy. It's a bit like gardening. You need to regularly tend to it to ensure its health and growth. So where do you start? Well, consider your financial goals, risk tolerance, and time horizon. Then seek advice from financial experts or do your own research to understand the best diversification strategy for you. In the world of finance, there are no guarantees, but diversification gives you a fighting chance. It provides a safety net that can help protect your hard-earned money from unforeseen events. After all, it's better to be safe than sorry, isn't it? Diversification is a safety net for your hard-earned money. Another safety measure is making sure your deposits are insured. This is a key strategy to protect your hard-earned money. But what does it mean to have insured deposits? Let's break it down. Insured deposits are a safety net for your savings. They are deposits held in a bank or financial institution that are covered by insurance. This means that even if the bank were to fail, your deposits would still be safe. This insurance is typically provided by a government agency. In the United States, this agency is the Federal Deposit Insurance Corporation, or FDIC. The FDIC was established during the Great Depression in response to thousands of bank failures. Its mission is to maintain public confidence in the U.S. financial system by insuring deposits. Here's how it works. If your bank is FDIC insured, it means that the FDIC protects each depositor per insured bank for at least $250,000. This includes checking and savings accounts, money market deposit accounts, and certificates of deposit. But remember, not all financial products are covered. For instance, stocks, bonds, mutual funds, life insurance policies, and annuities are not insured by the FDIC, even if you bought them from an insured bank. It's also important to note that the FDIC insures deposits in member banks only, so it's crucial to ensure that your bank is a member of the FDIC. In other countries, there are similar organizations. For example, in the United Kingdom, the Financial Services Compensation Scheme provides deposit insurance. In Canada, it's the Canada Deposit Insurance Corporation. So, no matter where in the world you are, make sure to do your research. Find out who insures deposits in your country and what the coverage limits are. As a savvy saver, it's important to understand these protections. They are your defense against the unforeseen, a shield for your savings. With insured deposits, you can rest easy knowing that your money is protected. Ensure your bank is FDIC insured or has a similar insurance scheme in your country, because when it comes to your financial safety, knowledge is your best protection. Having an emergency fund and making smart investments are also crucial. Now, let's take a moment to discuss the significance of these two components in safeguarding your savings. Firstly, an emergency fund. Think of it as your financial lifeboat. It's a separate pool of money, specifically set aside to cover unexpected expenses or financial shocks. This could be anything from sudden job loss, medical emergencies, or even a car repair. The key here is unexpected. These aren't your regular predictable expenses. These are the curveballs life throws at us. So how much should you have in this fund? Well, a good rule of thumb is to aim for 3 to 6 months worth of living expenses. And remember, this is not a fund to dip into for your latest tech gadget or a spur-of-the-moment vacation. This is your safety net, your financial buffer against life's uncertainties. Moving on to investments. When you invest, you're putting your money to work with the goal of increasing your wealth over time. This is your growth engine. Consider diversifying into assets like real estate or stocks. Real estate, for instance, has historically shown to appreciate over time, providing a hedge against inflation. On the other hand, stocks offer potential for higher returns, albeit at a higher risk. Of course, it's important to do your due diligence before investing. Understand your risk tolerance, educate yourself about the markets, and if needed, seek the advice of a financial advisor. Don't just jump in blind. Investing is not about getting rich quick. It's about building wealth slowly, steadily, and surely. It's about taking calculated risks to protect and grow your savings. In summary, an emergency fund and investments are two key strategies in protecting your savings. They work together, with the emergency fund acting as your safety net and investments fueling your financial growth. An emergency fund is your financial safety cushion, and investments are your growth engine. In summary, protecting your savings in the event of a bank failure involves several key steps. First, it's crucial to understand what bank failures are and how they can affect your financial health. Knowledge is power, and being informed can help you make the right decisions. Next, consider diversifying your savings. Distributing your assets across different types of financial institutions and investment vehicles can reduce the risk of losing everything if your bank fails. Also, ensure your deposits are insured. Many countries have deposit insurance systems in place to protect consumers, but it's important to understand the specifics of your country's system. Having an emergency fund is another key step. This is a separate pool of savings that can help you weather financial storms, including bank failures. Lastly, consider making smart investments. These can provide additional financial security and potentially offer higher returns. Thank you for watching. Remember to subscribe to House Lux Estate for more financial insights and tips. Until next time, stay financially savvy.